In 3 to 5 years, every financial institution and company on the planet will have blockchain connectivity. This was said by the CEO of Uphold, and I want to give you some more additional information. We also have a brand new clip from the Kwok brothers live on NASDAQ TV. I got to show you what's going on. And we have a ton of other things going on with the economy. They are about to push a lot of money into the markets. 2026 should be an incredible year. Let's find out what's going on here. The global financial infrastructure is over 70 years old, and it's urgent need of updating. Today, regulators, users, and technology are finally aligning and coming together. It feels like the mid-90s, the internet went from a passing fad to being the backbone of the economy in just a few years. In 3 to 5 years, every financial firm and eventually every company will have blockchain connectivity. The statement captures a real directional shift. Financial services are already moving rapidly towards on-chain rails. Over the next 3 to 5 years, blockchain connectivity is likely to become the standard capability for banks, brokers, and payment companies and large corporates rather than a niche add-on. This environment is structurally bullish for networks that specialize in institutional payments and tokenization like Ripple and the XRP ledger, but the upside will depend on execution, regulation, and how much share the XRP ledger captures versus stablecoins and bank-issued tokens. Simon McLaughlin has been positioning Uphold less as a retail exchange and more as an institutional on-chain payment, stablecoins, and tokenized assets, explicitly talking about turning into infrastructure providers like Uphold to connect to a growing number of blockchains. So there being an interconnectivity between all of this. Why 3 to 5 years? Is it plausible? Enterprise and banking adoption of blockchain is already in a new phase. Surveys show roughly 70% of financial institutions are making major DLT investments, and close to half are expecting significant capital market adoption over the next several years. Large firms are pursuing digital asset platforms, tokenized funds, and on-chain settlement because they cut costs, speed up cross-border and securities processing, and aligning with regulatory pushes for better transparency and data. For most institutions, having blockchain connectivity will mean access to multiple chains through intermediaries like custodians, banks, and platforms like Uphold and others, Ripple, Circle, all of those. Using stablecoins, tokenized deposits, and tokenized securities natively in treasury payments and capital market workflows alongside legacy rails like Swift and ACH, integrating these rails into core systems so clients can move money or assets cross-border in seconds with near zero fees, often without realizing it's a blockchain underneath. That's when you've reached mass adoption, when people don't even realizing they are using the underlying technology. The implications for Ripple and XRP: Ripple Stack is purpose-built for this moment. RippleNet and XRP Ledger enable real-time, low-cost border payments and are already used by banks and payment firms to avoid nostro-vostro pre-funding via on-demand liquidity, where XRP serves as the bridge asset. As more institutions demand tokenized value and instant settlement networks that are fast, cheap, and compliance-friendly, XRP among them can intermediate FX and cross-border flows, deepen XRP liquidity, and make XRP more attractive as a neutral settlement token. And the XRP's advantage as speed, low cost, and decade of optimization for institutional payments, plus works with real-world assets, AMMs, and potentially CBDC integrations, which will all add liquidity and utility to the ledger. However, some of the macro trends Simon also describes stablecoins, bank deposits. There's going to be a whole lot of solutions here, guys. But listen, I'm getting excited. All right, banks are coming. Awesome interview, trade talks, let's get it.
We all know that we've got the foundations there. We have amazing blockchains, like for example, the XRP ledger, which allow you to transfer any amount literally across the whole world for just fractions of a penny, right? You have stable coins like RLUSD, which then allow you to take $1 million, $100 million, $1 billion, or even just $1 and just send it across for literally, again, fractions of a cent. And what we are working on is allowing people then to access the opportunities and the financial opportunities that anybody in the world would access. You know, you can think about anybody anywhere in the world can't access yield based on their own currency. They can't access a US dollar-based yield. They can't borrow against their collateral. That's all what we're working on right now. And I think that that's why this is so exciting. We're looking at this phase of bringing, you mentioned banks, right? I think banks are this great example of banks are the first way that we have into the financial system. And to be honest, they're really the only way that most people get into the space in the first place. There's no ability to directly access. And we have amazing players like Robinhood who are giving more of that direct access. But I think that what we're starting to see, and this is a big theme that I think is going to grow into 2026, is that we're going to start to see way more of the world actually access finance directly through the blockchain for the first time ever.
Which is so interesting because it really was consumer driven, right? And now you're seeing the banks, I mean, clearly their
I know the clip's a little fuzzy. I do apologize.
priorities are faster settlement and being able to have, more control of that flow. But I think it's fascinating that it really was a consumer driven application and use case.
100%, yeah. I mean, I was just saying before, I used to work in finance. I used to work in TradFi, Blackstone, Goldman. And I think, one of the things that I always hear when I catch up with my old colleagues, and was catching up with a couple this week as well, they're really taking note about stablecoins. They're really interested in, what the actual practical use cases of the blockchain are. Obviously, ETFs are going live. New regulatory clarity is there as well. And so it's just a matter of time since all of these big institutions that traditionally have shied away are actually starting to come in and create their own stablecoins, like you were saying, create their own applications on the blockchain as well, and start to use the technology that we are building and that people on the ground are actually building.
Remember, 3 to 5 years, every company and financial institution will have blockchain connectivity. The biggest asset classes like Ethereum, Solana, XRP, Chainlink, those are going to be the assets for the new system. Obviously, there's a bunch of others, but those are the 4. When I'm talking about this, that was what comes to my mind immediately. You can throw XLM and XDC and Algorand and all those others on there as well, but that is the big 4 in my personal opinion. My conversation with Christopher Jensen, we discuss FTI, Franklin Templeton Institution overall approach to crypto. Thought this was valuable to add here.
Our base case is that 2026 is going to be an up year. I think the things that give me confidence in that view and the things that I'll be looking for to see how they play out is continued momentum on the regulatory side. We had Genius Act, right? As an industry, we're still waiting on Clarity Act or the market structure bill. So seeing progress there, especially, bipartisan support and that eventually coming to fruition, that's something we're keenly focused on. And then I think another thing that's continues to really improve and be different this time around is the institutionalization of the asset class. So, just this week, we heard about another bank, kind of onboarding Bitcoin, PNC. And so when we look at the full list, right, it's more and more, wirehouses and banks, and asset management firms embracing, this new asset class, allowing access to this new asset class. And so, as those doors open up and as more people come through them, even with small allocations, right? Small allocations from, big numbers really does move the needle here.
All right.
So our base case is that,
Let's keep it going here. I did want to share this. This is Mr. Lee talking about the Fed cutting rates, and I'm going to get into a little bit of why this is going to be good going into next year.
Well, I think precisely because our clients are expecting a hawkish cut. So exactly as Steve laid out, Fed does a cut, but future cuts are uncertain, not even maybe until June. Now, because that's the base case, then if that's what happens, of course, markets have already been bracing for that, and they've been bracing for it since October. And of course, there's a chance that it's a dovish cut, which would be bullish as well. And then I think
what to you would be a dovish cut? Are there projections? Are there dots?
Yes.
There is. So we'll know right away if they come out and those projections show that they're expecting more rate cuts next year. Then you're saying we might only get one more in the summer.
That's right, and it could also be interpreted dovishly if they start acknowledging the balance of risks are shifting, so that then markets can realize the Fed is now acknowledging there's some underlying fragility of the economy. And of course, now QE because QT is ending. It's essentially not QT, which is QE, and there's of course, the chance that there's something positive the Fed has to say. So I think it is a hawkish cut, but actually I think market reaction's positive.
And there's so much more you're queuing up here we're going to get into, but on a top level, why isn't it a bigger roadblock for markets, Tom? You could look at this and just say, well, we're already basically at all-time highs. Look at the Russells and so forth. And Powell's been known to not have a very favorable reaction to his commentary, and he's only got a few meetings left, so maybe he's even more hawkish than usual. I don't know. Why don't you think that's a bigger risk? And whether it's, I'm not just myopically even talking about this afternoon, but kind of setting the tone into year end and then into next year.
Yeah. I think part of it is just the market's now adjusted to the idea that the Fed is institutionally slightly hawkish. Now, part of it may be because that there could be undue pressure coming from outside the Fed, and the institution wants to protect its integrity, and that comes across as hawkish. But that dynamic is something the markets have been bracing for, and they've reacted negatively to it, like in October they did. And so I think because of that, that's what people are building.
All right, and we are getting QE. That is starting here next week. The Fed is going to print $40 billion the first month, which is a lot. And this money is supposed to be pumping up markets. There's some conversation about possibly doing some stimulus next year. I think that is going to be always good for the markets because people will take that money and invest it. But you got to understand on the other side of that, whenever we kind of start dealing with that, when we're printing money and we're giving out stimulus and printing even more money, eventually inflation will be coming back heavy, and hopefully people's wages will be able to keep up with that increase. Get ready. The money printer will start soon. The Fed says it will begin purchasing U.S. Treasury bills on December 12th, purchasing $40 billion worth. It is print time. And 21 shares, spot XRP ETF went live, providing investors with a liquid, transparent, and convenient way to gain exposure to XRP, a foundational asset in the future of global payments. Gotta love that. Thank you, 21 shares. Of course, they talk about the XRP army and the strongest community in crypto. We know that. You are the army. You are incredible. The XRP ledger is a public blockchain built for business since 2022. Real world institutional adoption via global payments, tokenization, and DeFi. Fourth largest asset. Congratulations to 21 shares. Now, here is Matt Hugon of Bitwise talking about why ETFs are important.
Financial institutions and financial professionals don't spend all of their time studying the markets. This is from a study that looked at how financial advisors spend their day. They work about 55 hours a week. They spend 5 hours of that on investment management. A lot of people think of institutions, particularly financial advisors, spending all day studying the markets. They spend 10% of their time studying the markets. Their average allocation to crypto might be 1% of their portfolio. That means each week they spend 3 minutes studying and thinking about the crypto market.
That's crazy.
That is actually how the numbers knit out. So why do they like ETFs? Because they know them, they trust them, they make it easy, and in 3 minutes they can buy it. Financial institutions...
That is crazy. 3 minutes a week. They got to spend more time. And I think you're going to see that, right? As all of these institutions and corporations want to move into blockchain connectivity, people at these institutions that are providing ETFs understand that they need to provide these services, access to these assets, because that is what people are going to be most interested in over the next few years. That is why they're all coming at the same time. And you're going to get 10, 15, 20 spot XRP ETFs, I'd imagine, over the next 12 months. Now, not all spot ETFs will be created equally, and there is going to be there's a lot of dilution because you have so many different products, and the biggest institutions will probably win the day. But I just wanted to clarify on both of those points. There are 124 active crypto ETPs filing across assets like Bitcoin and XRP. Here is Bitcoin 21. Basket, which is a bunch of different cryptos, is 15, and XRP's in third place at 10. We are coming, Mr. 15 Basket. Listen, I think we understand how important XRP is. Yes, Bitcoin is a great store of value, and institutions are most interested in getting into that first because it has the most liquidity. But watch out, right? I will go I will back utility over a store of value any day of the week, because XRP technically could be a store of value too. Yes, it is more, goes up and down a little bit more aggressively than Bitcoin right now because there's not enough liquidity in it. Once that comes through, what do you think the institutions would rather hold? Bitcoin, store of value, or XRP, everything and a store of value? I'm picking the everything basket. And of course, we did cross $1 billion in assets under management for the ETFs, guys. This is going to get exciting as we make it through the next few months here. Binomial CFTC XRP derivatives just in. Eleanor Terrett says, acting chair Caroline Pham has named the first group of the exchange CEOs a new CFTC CEO Innovation Council, a forum that will tackle market structure issues and derivatives. It looks like we have people from SIBO, CME, Bullish NASDAQ, Binomial, which Ripple invested in, Kalishi, Polymarket, Crypto.com, LSE Group, PLC, Kraken, Ice Markets, and Gemini. That will be who's going to lead this CFTC working group, hopefully to help set proper regulations in the market so crypto can flourish and be adopted. I will leave it there, guys. Thank you so much. If you got any value, you can like, share, leave a comment down below. Have a truly fantastic day. I'll see you. Bye.